Now recording. Welcome, everyone. Really pleased to have everybody here today attending our Plan Giving 101 Legacy Planning Program. This is actually one of the first times we've done this particular topic. In the past, we've done legacy planning, and Rich Merck, who's attending right now, has been a presenter for that particular topic. Today, we're going to be talking specifically about financial instruments and different financial strategies that support your using your assets and your financial gains with supporting organizations like Maine Woodland Owners, in essence, supporting Maine's forests. So we were very lucky to have Amy Lawrence. She is from Bangor Savings Bank. She's the Senior Relationships Manager and Vice President, Wealth Management Group at Bangor Savings Bank. She is a native Mainer, and more, I would say, pretty much. I think we were talking in that there had been some time outside of Maine, but primarily has spent most of her life in Maine. And she's very enthusiastic about the idea of working with clients who want to be smart with their money, but also use their money to support good causes. So she has been a wonderful partner to work with since we started developing our Plan Giving program here at Maine Woodland Owners. And she's given us a lot of great guidance on what it is that we can do to encourage our supporters to plug in and take the giving to the next level. And I have asked her to continue helping us after this program, and I believe she'll stay as a partner long term. We're very proud of the fact that we've launched a Plan Giving program, and it's slowly developing into something that we can really, I think, use as a way to communicate with our supporters to think of us when figuring out how you want to do charitable giving. And the smarter that we get with this, I think the better it will be for our members and supporters. So we're really glad that we can offer this program today. Again, my name is Jen Hicks. I'm the Director of Outreach. I'm the Director of Communications and Outreach at Maine Woodland Owners. And I'm very glad to introduce Amy. One thing I do want to say is that she's very flexible with her presentation. She's got a great slideshow. However, some of the stuff could get a little technical. So if you do have any questions while she's giving a presentation, she said she is happy to answer them. So there's a couple ways you can ask your question. You can type your question in the chat box, and I'll be watching for that. And if I see something that's relevant to what she's presenting at the time, I'll stop her and read the question to her. Again, you can, if you have your video, you can raise your hand, and I'll be looking out for that. And then you can also, if you just want to write down your questions and then wait till the end of the presentation, we will create some time for Q&A, and then we can manage the questions that way. But whatever works best for you is good for us. So that's the deal with our dialogue today. So I'm going to pass the mic, I guess you could say, to Amy. And Amy, again, thank you so much for your willingness to do this today, and it's all yours.
Thank you, Jen, very much. Really appreciate it. First of all, thank you all for taking the time out this afternoon. I know it's a nice, almost spring-like day today, so I can imagine it might rather be outside enjoying a walk. So thank you for taking the time to come to the presentation and be a part of it. And as Jen mentioned, I welcome the opportunity to make this as interactive as possible. To give you a little bit of background about myself, I am a proud Maine native, growing up in Brewer. But as I joke to people, I lived in exile for about 20-25 years down in the Boston area. Majority of my time down there was with State Street Corporation, working in the Charitable Asset Management Group of State Street Corporation, which does investment management and fiduciary services for nonprofits, plan giving programs, and enjoyed that very much. And I followed up with that afterwards, working at Boston Private Bank and Trust Company on the personal side, as well as continuing with helping institutions on the plan giving programs. When the opportunity arrived to come back to Maine, it was wonderful to be able to find a niche here at Bangor Savings Bank that has the culture that really believes in the importance of nonprofits, and not only our communities, but to our health and well-being of our employees. So I feel like I've come full circle, and happy to be back in Maine and doing the work that I enjoy so much. So I thought I'd begin first by just kind of getting a review of the different types of giving. We often think of giving on an annual basis, where we give year after year to our favorite charities, and that may be as simple as writing out that check, or it could be donating highly appreciated securities, which I find would be a very, very good gift for an individual to give to the charity. A lot of times, especially when we've had a long run of a great, strong market, and as a result, a lot of people have highly appreciated securities in their portfolio. And by gifting a gift of appreciated stock, you would avoid the capital gains that you would otherwise have to recognize if you went and rather sold that gift and recognized the gains and then got the cash and then distributed, issued a check to the charity. Rather, it'd be more tax advantageous to give the charity the stock gift directly. So that would avoid the whole capital gains tax. It's generally not considered a planned gift because it's annual, like year after year. You are entitled to a charitable income tax deduction. Whether you'll end up using this or not is really dependent on your tax situation. A couple of years ago, the standard deduction almost doubled, or really did double, to over $25,000 per couple, $12,500 for an individual. So there's a lot less incentive in terms of itemization that you need in order to take the charitable income tax deduction. You would be needing to itemize, and with this large standard deduction, that's less of an incentive, but certainly the capital gains is a significant advantage of why to gift highly appreciated security. And we'll talk about another annual gift shortly, but in a few minutes. Bequest, I really like this one. Bequest really become a bread and butter for many for charitable organizations. In fact, I heard a statistic where about 80% to almost 90% of their total values of their gifts come through bequests. What is really nice about bequest for you as a donor is there's a lot of flexibility involved with a bequest. It can be in many shapes or forms, cash, stock, even real estate, and can be gifted through bequest. And it's done through your will. And again, it's flexible in the sense that it can be changed anytime during your lifetime. It's just a matter of writing a codicil to your will, updating your will. It can be in various forms. It can be a specific asset. So if you want to give just name the 100 shares of Apple, you can have that. You can have a dollar amount, what we call a pecuniary amount, and say, I'd like to give $50,000 to Maine Woodland Owners. Or it could be a percentage of your estate, 10%, 5%, 50%. Even a residual of your estate. In that case, you could name your children to get a certain amount, and then anything left over go to your charitable organization. So there really is a lot of flexibility with this gift. And it's when you gift, it's got the unlimited charitable estate tax deduction associated with it. Another planned gift is a designated gift. This is one that you would name, actually naming the charity on the document. and the beneficiary designation document for an IRA or a retirement plan, such as a 401k plan or 403b plan. Or you could name the charity as the recipient of your life insurance policy. The nice thing about these gifts is that they're outside of your estate, so they never get picked up in the estate and they're exempt from the state tax. The last one, gifts with attachment, is the one that I really is the meat and bones and kind of has some technical aspects to it. But what I really like about this gift is it's oftentimes people have a large asset and they say, well, I'd love to turn it over to the charity, but I really want to retain some sort of benefit from it. Gifts with attachments will allow this. It can provide an income stream to you as the donor or any other named beneficiary. It could be for the lifetime of the beneficiary or a term of years. And depending on when it is funded, you would receive either a charitable income tax deduction or an estate tax deduction if you established it through your estate. The next, before we go on to planned gifts, I want to really touch home on this type of annual gift. This one I really think is a wonderful tool for those who are 70 and a half or older. They have their large portion of their assets are in an IRA account. And they have the ability to, at that time, when they're 70 and a half, to give up to $100,000 annually to their organization. And the nice thing about it is it's not included in your adjusted gross income. So there's no tax reporting on that. It's not recognized for your income. And also it counts towards your required minimum distribution. The catch on it is you got to make sure that payment is directly made from your IRA account to the charity. That's very important. So you cannot cash out, take your RMD, get the distribution, and then cut a check to the charity and say that this represents a qualified charitable distribution. The good news is this has been around for a number of years, and for a while it was not made permanent, but then it just kept getting extended year after year. And finally they made it permanent about 2, maybe 3 years ago. And IRA custodians and trustees are very comfortable with this. They know, they recognize this, and they can work with you and making sure to get the forms in place and everything that you need to make sure that it goes directly from your IRA account to the charity. The question I often get on this is, well, what about my 401k plan or my 403b plan? Can I make a direct qualified charitable distribution from those plans? Currently, they're not allowed under IRS because they are employer-sponsored plans. They have their own type of what we call ERISA rules, and so that prevents that type of direct distribution. However, I'd like to point out that doesn't mean that you can't still do this type of gift. My recommendation is if you have a large 401k or 403b plan from which you think you would like to start making significant distributions from to your charity, you could do an IRA rollover. So that would mean rolling over your plan to a traditional IRA. And then you could make distributions from that newly established traditional IRA account. So let's give an example of how this might work. What are the benefits of it? Let's say for this year, your IRA required minimum distribution is $50,000. And of that $50,000, you want to donate $100,000 to Maine Woodland Owners. You could use a qualified charitable distribution, QCD, the acronym, to donate $10,000 directly from your IRA to Maine Woodland Owners. Again, working through your custodian to have that executed. This 10,000 reduces your required minimum distribution down to 40,000, and that 10,000 is excluded from your taxable income. So the tax benefits, one, you lowered your adjusted gross income because that's not even recognized. That 10,000 is not recognized as adjusted gross income. Could potentially lower your tax bracket. This one would be particularly advantageous if you happen to be between tax brackets. Looking at the 2021 tax brackets, I've noticed that there's a large bump up between 24 and 32%. If you're in that tax bracket at 32% and you're just on the edge of it, on the lower end, it's possible that you could, by making a significant or maybe not so significant, depending on how close you are, to bring that tax bracket down for all your taxable income. Your Medicare premiums are tied to your income. So if you take out that 10,000 or plus or more, it could affect your Medicare premium amounts that come out monthly, as well as lowering your taxable portion of your Social Security income, which is can range from either 50 to 85%, depending on your income level. And the last one is geared more towards higher income and in avoiding the surtax on wealthier individuals that have to pay for surtax on their net investment income. Now I'd like to turn to actually planned giving. So planned giving, what is planned giving? Planned giving, also referred to as gift planning or legacy giving, is a gift to an organization that extends beyond the donor's lifetime. Some planned gifts provide an income stream, while other planned gifts maximize transfer tax and or minimize estate tax. Simply put, a planned gift is any major gift made during life or at death as part of the donor's overall financial and estate planning. One of the more commonly used instruments for planned giving is what we call a charitable remainder trust. Charitable remainder trust is, like the word itself, is an actual trust. So there is a trust instrument, and within the instrument, you'll have various components. One, you have the interested parties. You have the grantor, also named the donor in this case. There's the trustee. The trustee can be the donor, or it could also be another named individual, or you may prefer to have a professional trustee, a bank, Bangor Savings Bank. There's also income beneficiary that will receive income from the trust. And final interested party of the charitable remainder trust, naturally, would be the charitable remaining interest that was of the recipient that ultimately receives the funds. So from the trust, there's an income stream. It can either be to the donor or any other named beneficiary. It can be a fixed amount, which means it would not change year after year, or it could be a stated percentage amount. And in that case, it would be a fixed percentage amount, which is revalued annually. So what happens is you would, in the trust instrument, there would be a designated valuation date. Typically, it's either the first day or the first business day of the year. And each year, the trust, based on that snapshot of time and the percentage amount, will set the payment for that year. So the payments will fluctuate year after year under this scenario. Within the charitable remainder trust, it'll be very outlined a set term. And the term can be either the lifetime of the income beneficiary or a fixed number of years. And if it's a fixed number of years, it can't be no more than 20 years. Upon establishing the charitable remainder trust and funding it, the donor gets charitable income tax deduction, and we'll talk a little bit more about what that actually is, as well as, or charitable estate tax deduction if it's funded at death. It's important to know, though, when you do set up a charitable remainder trust, that the trust cannot be modified or changed, so it's irrevocable. And the trust itself is tax exempt. It's a split interest, meaning you have two parties. You have the income beneficiary, and then you have the remaining charity. The trust itself, while it does have a tax ID number, it's not taxable itself. Rather, the income that comes off the trust, it's paid out to the beneficiary, is taxed to the beneficiary. And it's taxed on a what we call a tiered schedule, which is very unique to charitable trusts. I won't go into detail about the tiered schedule, but recognize the fact that the trust itself is not taxable. It files what we call an informational return, which then produces what we call a K1 or a tax letter, the income beneficiary, and is taxed in accordance to a specific tiered schedule unique to charitable remainder trusts. So how does this all work? This is, I thought would be a nice way to kind of see the flow. You can see right in the middle is the charitable remainder trust. To the left, you have the donor. Underneath the donor is the beneficiaries, and to the right is the charities. The donor will work with their legal counsel in forming and executing a charitable remainder trust instrument. Again, talking about the parties and parameters we just spoke of. And upon execution, the donor will fund the charitable remainder trust. The donor can fund it with appreciated stock, cash, can be a non-income producing real estate property. It could be a vacation home that you no longer, your family no longer uses and doesn't want to pay the bills anymore and would rather find a more way to get income from it instead. So what would happen is the donor could retitle that property to charitable remainder trust. The charitable remainder trust will sell that property or that security and invest the proceeds from that and make it more diversified portfolio and invest in accordance to the trust instrument and be much more highly diversified than it was with that single asset. The donor gets a partial income tax deduction, and this is the present value of the ultimate gift that's going to be going to charity. So it's based on actuarial calculations. So it takes into consideration the nature of the trust, the type of trust, which we'll drill down more deeply to in a minute. We'll look at the term of the trust. How long is it going to be? The expected life expectancy of the individuals, or if it's a term, the number of years, and what's the current IRS discount rate. That all factors into what the donor can take as a charitable income tax deduction in the year of funding the trust. The income from the trust goes back either to the donor or to other named individual beneficiaries. Upon the termination of the trust, in case of the lifetime of the beneficiaries, upon the death of the last named income beneficiary, or if a term of years upon the ending of the number of years. At the term of the trust, the charitable remainder trust, all the assets that are in the trust at that point, distribute out to the charities named in the instrument, and the trust is terminated and closed. The benefit of all of this is the fact of you've made a great gift to an organization, provided an income stream to yourself or to other named beneficiaries, and took something that was maybe a highly concentrated stock or a non-income producing property and turned it into an income stream. Jen, is there any questions at this point? Comments?
So I haven't gotten any questions yet, so sounds like everybody's okay for now.
Great. And please don't hesitate to raise your hand, and Jen can stop me at any time. I'm happy to do that. So when we think of charitable trusts, they come in really two varieties, vanilla and chocolate, I guess, for lack of a better analogy. So the first one is the Charitable Remainder Annuity Trust, or what we've been in acronyms. There's always these acronyms flowing around, like everything that breaks down to acronyms that are commonly used in the business. So a charitable remainder annuity trust is kind of what you would expect when you hear annuity. It distributes a fixed annuity amount each year, so it never changes. So for example, if you set up a trust at the beginning of the year in January, when the value of it, you funded it was 100,000 and it was 5%, you'd be paid 5% every 5,000 every year annually. If it was the first year and you funded it midway in the year or 3/4 of the year, it would be prorated for that first year, but then thereafter would be the 5,000. But the point is, it's a fixed annuity amount each year. So if the value of the trust goes down, you'd still get that fixed payment amount. If it goes up, you still get that fixed payment amount. With charitable remainder annuity trust, you cannot make additional contributions to it. So it's only an initial funding. The other flavor of trust is the Charitable Remainder Uni Trust. This distributes a fixed percentage and on the value of the trust assets. So going back to the trust instrument, even on the annuity trust, you would list 5% be paid out, but it would only pay out, it would pay out 5% based on that initial funding. This would also say pay out 5%, but it would state in the document to be revalued, and it would be revalued each year, annually each year on a specified date, and that would be listed right in the trust instrument. And again, commonly used is first business day or first day. Doesn't have to be that way, but that is what we typically see. What happens with the charitable remainder uni trust? You have you as the donor and or income beneficiary are tied to how the performance of the trust does. So if the trust goes up the next year, your payment goes up. So for example, we talked about the 100,000 funded this year. If the market did really well and the trust benefited from a good market and then revalued the next year at the beginning of the year at 110, now your payment for the 5% would be 5,500. Similarly, if the market goes down next year, and let's say it goes down to 90,000 when you revalue at the beginning of next year, your payments for that year would be 4,500. So in the case of the uni trust, you're really tied to the market, but you get the benefit if it goes up, but also tied to if it goes down. So you might say, well, okay, if I do an annuity trust and I always know what I'm getting, well, that sounds good. Well, I have to be honest with you, they are good, but in the sense they can deplete much more rapidly. You will never have a depletion on a uni trust, where a charitable remainder annuity trust, in my business, I've seen where charitable remainder annuity trusts were established many years ago, and based on the fixed percentage amount, depleted the trust to the point of exhaustion. So it can happen with a charitable remainder annuity trust. Crap. There's variations on charitable remainder uni trust, and that's the other nice part about a charitable remainder uni trust is there's some flexibility and planning that you can do with these. The first one that I just spoke about and talked about, vanilla Charitable Remainder Uni Trust is what we call the standard Uni Trust, the fixed percentage. So it changes year after year, the amount. It's always tied to whatever stated percentage is in the trust instrument. But again, will fluctuate based on the how the trust is doing from year to year. Another variation on that is net income uni trust. So you could put in there, well, I would take the lesser of trust net income, whatever the net income generated from the trust, or the fixed percentage amount. So for example, if the trust only earned 4% that year and the stated document said to pay the lesser of trust net income or 5%, and the trust earned the 4%, you would receive 4%, which would be lower than the 5%. The benefit here is it gives more opportunity potentially for growth in the trust and increase the value over time. Why not combine the two? This is one that I've seen used a lot for retirement planning. Donor may be in their 50s and begin set it up so that the trust pays net income for a certain amount of time.
That's good. I was able to get that printed.
And then it flips to a standard fixed percentage amount at a future date. The important thing about that one is the event that triggers it to the fixed percentage cannot be in your control. So for example, 65 age, upon reaching age 65, it flips to the standard fixed percentage. So you can't, it has to be an uncontrolled event. But that's a nice one that I've seen a lot, utilized a lot for those people that have assets right now that don't necessarily need the net income, and they're looking more for the income tax deduction right now. But at some point in the future, when they are no longer working and are retired and they're looking for more steady income, this can be a nice tool, nice type of trust. So what are the benefits of charitable remainder trusts? To recap, there's immediate charitable income tax deduction. So the year of the funding of the charitable trust, you receive an immediate charitable income tax deduction. Again, this would be based on that you're itemizing to take the benefit of that, but it is certainly definitely a benefit. No upfront capital gains tax. So if you funded it with a highly appreciated security that has built up gains in it, you put it into the trust sells it, and as we spoke about earlier, the trust itself is tax exempt, so it doesn't pay the capital gains tax. But it does go into this tiered schedule that I briefly mentioned, so that the capital gains goes into these buckets that get spread out to the income beneficiaries. So there is some reporting out to the income beneficiaries, but it is on a much more spread out basis. Steady income stream, this is what we were talking about before. It provides, the nice thing of a charitable remainder trust is some ability to do some planning around getting a dependable income stream. And always you have to remember at the end of the day, you have to have a philanthropic will, and that it is a contribution to your favorite organization, and that it's only going to work that you have the understanding that that is part of the plan. Jen, before I continue, I just want to make sure there's no questions.
None that I've seen. I am going to really quickly invite Peter Jones or Tom Doak, staff on our two of our staff members that work on development matters with our organization. If there's anything you wanted to chime in about? Otherwise, I think we're okay.
Hi, this is Tom Dope. The only thing I would say, when we get a chance, I'd like to hear, who does what in helping to set these up. So for folks that, you mentioned, an attorney, but the role of, like Bangor Savings and, who manages the money and that, some kind of explanation of how someone would go about setting them up would be useful, I think. And you may get to that, I'm not sure, but.
No, I think that's a great time to talk about, because that's exactly what this is all about. Charitable Remainder Trust, it is a legal document, right? So we don't act as attorneys, so it would have to be prepared by working with your legal counsel. And certainly we would review it if we're going to be trustee. We can serve as trustee. As I mentioned, there's 4 parties really involved with it, and you have the grantor or slash donor setting it up. You have the trustee, so they have to talk about, who would they want to have as a trustee. So that would be either the individual or the other named, or in any other named beneficiary, any other named individual inside, or it could be a professional like Bangor Savings Bank could serve as a trustee. But again, it would be the donor would have to have some legal counsel, making sure that the trust instrument is a qualified charitable trust, because in order to get that income tax deduction, it's important that it is qualified. So if the bank, Bangor Savings Bank, we can serve as trustee, and we would review the trust instrument before you execute it to make sure that we can serve as trustee and that there isn't any issues. So we'd be happy and encouraged to review the trust instrument before you actually sign finalize and execute the instrument. And then the bank would also serve as investment manager. So as you I talked about, you would fund it with an asset or assets, but typically you don't keep those assets, right? So, there's no incentive to keep a trust going with just a one stock or a highly concentrated portfolio. So what we would do is the bank as trustee and slash investment manager would sell that asset and then diversify the portfolio. And we would be covering much more broad diversification across asset classes, and as well as fixed income, and making sure that we are managing the portfolio and the trust prudently, and making sure that we understand, you could have an 8% payout on a trust versus a 5%, and that we have a different type of, could have potentially a different asset allocation mix between equity and fixed income in order to balance that payout, that higher payout. So that would be another role as the bank. That's why I encourage to have a professional trustee to do this. We would also, as the trustee, would be responsible for the tax preparation for the trust. Again, as I said, it noted, it's not taxable itself. Rather, it's what we call a split interest, and it files what we call an informational return, and that then produces a K-1 out to the individual. So you definitely have to have an accountant that understands the unique nature of the taxation on charitable remainder trusts. We're very comfortable with doing that. Does that answer your question, Tom?
Yeah, that was great. I just wanted to understand for folks, where they need to go to get help, and the type of different people. They're going to need to deal with their own an attorney, but then they need to figure out who's going to be the trustee.
Yeah.
Bangor Savings can serve as the trustee and the manager of the assets.
Yeah, and
if
even
they
more
chose or not, but right. That's
exactly.
part of what wealth management does in the bank, right?
Exactly. So
Yeah.
Thank you. Yes, exactly correct. And that's really, and people forget that they think, oh, well, I'll just self-trustee this. Well, there was a lot involved, and as you can see, between investment management and tax reporting, to just
Right.
do the tax reporting is very unique.
The only other question I had was, I think you mentioned that, and I can't remember which one of the trusts it was, but there's the trust that doesn't have to pay the capital gains, but when the distribution goes to the beneficiaries, that can be that there is a capital gains treatment of that that portion of that goes to each of those beneficiaries, and so the beneficiary would be subject to the capital gains tax on that gift. Is that right?
That's absolutely correct. So it doesn't avoid, and a lot of people, and I see this in articles sometimes. It can be very misleading to say, oh, well, the trust doesn't pay capital gains tax on for the charitable remainder trust, so you can donate a highly appreciated asset, won't have to report won't have to recognize the capital gains. Well, that's correct in the sense that the trust doesn't have to recognize the capital gains, but it doesn't mean that the income beneficiaries don't. But the nice thing about how it works in the income beneficiaries is they have this, what they call a tier schedule, and it's 4 tiers. As I recall, it's first ordinary income, short-term capital gains, which is the same level as ordinary income tax rate, and then long-term capital gains, and then what we call corpus or tax-free. So as you can imagine, it always takes out the highest from the highest bracket first. Right. And then works its way down. So there's kind of this, putting them in the buckets, and then depending on what amount comes out to the income beneficiary, let's say 10,000. Well, if ordinary income is 4,000 and capital gains is 6,000, that's how it would be taxed. 4,000 at their ordinary income tax level, and then the 6,000 at the capital gains.
Okay. Terrific. Thank you.
Yeah. Any other questions, Jen, or comments?
I don't see any. Anybody want to jump in? No, we're probably all right.
Okay, so then this last one is this one's one that's kind of becoming a little more in favor now because of the low interest rate environments. Is still not as nearly as common as the charitable remainder trust. The charitable remainder trust is really the most commonly used trust vehicle for gift planning. But charitable lead trust is really kind of what we think of is a charitable remainder trust in reverse. Instead of the income stream going to the individual, whether it be the donor or the beneficiary, instead it would be going to the charity. And then at the end of the term, it would either pass back to the donor or pass back or go out to heirs or other named individuals. So it's the flip of the charitable remainder trust. Its term can be either, again, life or lives of an individual or individuals. It can be a set term of years. Unlike the charitable remainder trust, it doesn't have the 20-year limitation. We talked about the charitable remainder trust having if you didn't do it on based on life expectancy of the income beneficiaries, but rather a term of years, it could be no more than 20 years. That does not apply in the charitable lead trust. Works in terms of the payments to the charities, so there's the same type of unique, same type of flavors that we just talked about. They have the CLAT, which is the charitable lead annuity trust. Again, the word annuity, so it would mean that the charity is getting a specified amount each year. Again, going back to our example, the 5% funded with 100,000, the 5,000 this time would be now going out to the charity each year during the term of the CLAT. The other is the charitable lead uni trust, or the CLUT, and that's based on the fixed percentage of the trust assets, again revalued from year to year. So similarly to how the PRUT works. The PLUT works the same way, except now the payments are going to the charity. The income stream is going to the charity, and the remainder would be non-charitable interest, whether it be the donor or other named beneficiaries. So upon the term, remainder interest, we talked about that, donor individual receives the remaining principal at the end of the trust term. So we talked about CRTs being tax exempt. Well, charitable lead trusts are taxable trusts, so they are not tax exempt, and they can be either taxed to the grantor / donor when they at the donor's tax recognizes the tax from the charitable lead trust. So any activity within the charitable lead grantor charitable lead trust would be taxed to the grantor. A non-grantor charitable lead trust is any income within the trust is actually taxed at the trust level. So when might a charitable lead trust be attractive? What comes to mind for me when I think about this is probably a grantor lead trust could be attractive for a donor. If a donor had in a particular year had a high income, they might have had a sale of a business for a particular year. They're recognizing looking at a huge tax bill. This could be a year in which to form a lead trust and then also fulfill maybe a large pledge that they've always thought about giving to the organization. Because what happens with the grantor lead trust is the grantor / donor gets an charitable income tax deduction upon funding the charitable lead trust. And it would be that charitable income tax deduction would be the present value of the income stream going to charity. So it could be a way to offset that income that is, if they have especially if they have a particularly high tax year. The other one, the non-grantor CLT lead trust, this one is less commonly used because the fact is it's tied to the estate tax and gifting, and without getting into too much nitty-gritty, the gift tax and the estate tax are what we call unified together, and they're very high right now. So you can gift during your lifetime or at your estate. You have an exemption now currently of 11.7 million. So we're not looking at many estates with that level right now, with that significant wealth. But for those that do have taxable estates, this can be an effective way to pass on to make a significant gift, first of all, to the charity. There's definitely that, but also transfer assets to heirs at with great potential for passing on assets that have appreciated free of gift tax. Because what happens is the gift that's donor recognizes is at the time that the gift is made. So if at time when the non-charitable beneficiaries, the children, let's say, receive the assets many years down the road when it comes to termination, because again, it's the flip side of a charitable remainder trust. The income stream was going to the charity, and then at the end of the term, would go out to the individuals. Well, at that point, there's potential that has grown significantly since the initial funding, which established the present value of what they anticipated the gift to be. So that appreciation is passed on free of gift tax. Why this might come into play, though, is I think there's some talk in the Biden administration of lowering the exemption amount down to 3.5 million, which is what the exemption amount, gift and estate tax exemption amount was back in the end of Obama administration in 2009. So this one may come more into play as if we start seeing the estate tax exemption level come back down. And this one's kind of, a little bit confusing, but it does have its benefits. So I definitely, it has its reasons to set up. And again, this is just reiterating why in a low interest environment, a charitable lead trust could be advantageous. And, we all know we're in a probably the lowest interest rate environment many of us have ever experienced. So again, the present value of what's ultimately going to be gifted to the future, to the ultimate beneficiaries, it's set at the time of the gift. So the calculation is based on the IRS, what they call the IRS section 75/25/20 rate. And again, I don't want to bog down in the terminology, but the idea is we're in a very low interest rate environment. And when the donor makes the gift, it's at the time of the gift that's locking in that gift value that's ultimately going to the heirs. But on the longer term, the potential is that these trusts, the assets will appreciate, and what is ultimately given to the children will be much greater than the present value that at the time of the gift. So, for example, if a donor had established a charitable remainder lead trust that had current value of 20 million, and the calculation was such that it worked out to 50,000 for the present value of what's ultimately going to be received by the children upon the termination. And then at the time, over the term of the trust, the assets grow, and at the end of the term, it ends up that the value of it is 100,000. Well, 50,000 of that value of the 100,000 has now been gifted to the children or other heirs or beneficiaries free of gift tax. And that kind of wraps up my presentation, but I'd be happy to discuss any other thoughts or questions you may have.
Amy, thank you very much. I wonder if anybody wanted to ask a specific question of what their interests might be in, or what information they're seeking specific to their circumstance. You can go ahead and just unmute yourself and jump in and offer that. Also, Peter Jones, did you want to jump in as our development consultant for our organization? If there's anything you wanted to tie in with what Amy was talking about?
I do. First, that was a great presentation. Thank you very much. And having worked with really good plan giving officers throughout my career, I just want to read a couple things just to touch on. Again, these are complicated. I think you really do need to rely on a really good professional. I've worked through some of these before, but again, I've always had really, really top-notch plan giving officers to help me guide me through them, to guide through them. But again, your presentation was good because I continue to learn things. Again, you just covered a lot of issues that sometimes I, even as having practitioner, overlook. But again, I'll reiterate, it's just these are, especially the tax consequences, especially depending on the size of the gift, the tax consequences are really, really important to really understand from the donor side why, yeah, a lot of people give from the heart, but still you have got to really make some really sound financial decisions. But at the same time, I think for Maine Woodlands owners, it's been great to be able to launch a planned giving program and to hopefully continue to work with Bangor Savings Bank as we, as members approach us about opportunities, planned giving opportunities.
I was going to jump into part of why we really want to be openly conversant about the opportunities, basically, that supporters could take advantage of to set up themselves maybe in a more tax-friendly way and manage it so their income becomes part of their charitable giving, is what we're most interested in. It doesn't matter to us how you want to give. We want to make sure that you feel informed. And if there are some long-term plans that you're thinking about making for that would include our organization as a recipient of your generosity, we'd love to know. And I know that it's hard to predict how much or how it's going to get, what ultimately will happen revenue-wise. But the fact that people are thinking about us is something that we're really interested in knowing. A lot of it's just so we can thank you, and so we can be aware of what might be coming down the pike. This is a little different, but we do every once in a while we receive a bequest, and often we don't even know we're going to get it until it arrives. And I think there's, for some people, that's meant to happen that way because, again, they don't know what they're going to be getting, what will be available, or what will actually be gifted to our organization. But just the thought, just the idea that you might be thinking about us in part of your charitable giving is a really great help for us, so we know that we are in, we're being thought of, that there may be some opportunity down the line, and what can we do to help to make that process easier. So I think that's where we come from as an organization.
Very nice. It's exactly
So,
true.
Amy, and I know Amy as a financial planner, she's learned more about us now. So that's also a very good thing. And I know that you give advice to your clients who are charitable minded, and encourage them to think about how that could play a role in their financial planning.
Be happy to have any conversations with you and your donors at any time. I'm happy to do that.
We have some very generous people in our midst, both just with our support, but also just the interactions that I get from people and how generous they are about how happy they are with what we do, or how thankful they are about what we do. And so it's been it's been a pleasure to interact. So I suppose this would be another good conversation, or this is a great way for me to hear from folks. So I would encourage this group and beyond. This is being recorded, so if you're watching this, reach out to us, drop a email. You can reach out. Tom's even better than me to talk to. Tom Doak, our executive director, is a wonderful person to reach out to if you're thinking about a long-term charitable giving plan. Reach out to us in our office at 626-0005 in Maine 207 area code, or tom@mainewoodlandowners.org, or I'm Jen at mainewoodlandowners.org. So we'd love to hear from anybody who's got questions or maybe thinking about doing something. And Amy is one of many terrific financial planners in the state, but we have a relationship with Bangor Savings Bank. We've been very happy with our relationship. So that's why we invited her to do a presentation today. Anybody want to offer a thought or jump in? We've hit our time limit, but we have time for a quick question or anything you wanted to throw out there.
Jen, I would just add that the nice thing about taping this is that was a really nice presentation that we'll be able to put up on our website and then have other people see it. So we'll be able to use this presentation on a number of times, or a lot of other people can see it. And it's a good opportunity when someone asks us about what are the options, we can say, here's a video, here's something you can watch. And so as a start to better understand too. So this is,
We do have a web page dedicated to plan giving. So thank you, Tom. That was a good reminder. This video will be on that page, and it's let's see, I will send an email to everybody with the link to that page. It has a brochure that talks about what Amy presented today in a more short form. So it's a good guide. And then we're also putting articles in the newsletter periodically about how you can include us in your estate planning and your long-term legacy planning.
and I want to thank Amy also for helping us with both she reviewed the brochure for us and has helped us in a number of ways. So thank you, Amy, for all the help and the great presentation.
My pleasure.
So feel free to send questions if something comes up after we've signed off today. I know Amy's happy to talk to anybody who has questions. And I can forward that. Amy's, you want to just say your email address really fast?
Sure. Amy, AMY, .Lawrence, LAWRENCE, @Bangor.com.
Terrific. Terrific. Thank you so much. And for everybody, I hope you got some information that's useful. Look forward to hearing from people, and have a great rest of your evening. And we're going to have 3 programs in March as part of our online virtual forestry information sessions. So I'll have that updated calendar on our events page in a day or two. But we have some silviculture Q&A, forestry Q&A, and timber tax, which is another issue this time of year. People are thinking about how to include tax considerations for your forestry, any revenue that you might have gained from forestry activity. So please join us for that. Thank you very much for being here tonight. I hope everyone is well and be safe. Thank you.